If you scroll through the financial headlines or wander into any retail message board right now, you'll see one company being crowned the next great darling of the defense tech world. That company is Ondas Holdings. And here's the number everyone's obsessing over: 44% short interest. Yes, you read that correctly. Almost half of this stock's tradable shares are being bet against. So the entire internet is asking the same explosive question. Is this thing about to detonate into the mother of all short squeezes? Or is it about to crash straight through the floor? At first glance, Ondas looks like a clean, straightforward rocket ship growth story. But there is a massive contradiction hidden in plain sight. What if I told you that the enormous profit everyone is cheering about is essentially an accounting illusion? What if the short squeeze that traders are frothing over is a trap that isn't even locked? And what if the real story here isn't a squeeze or a crash at all, but something far stranger sitting in between? Today, we are doing a complete fundamental teardown. We are ripping apart the market narratives, the complex accounting realities, and the surprising institutional positioning driving this stock. We're going to look past the hype, past the noise, and figure out what is actually going on under the hood. By the end of this, you'll understand this company better than 99% of the people currently trading it. If you find value in deep breakdowns like this one, do me a quick favor and hit that like button and subscribe so you never miss the next teardown. It genuinely helps the channel grow. Now, let's get into it. That sounds impressive, until you look at what's happening underneath the shiny headlines. The contrarian view here is simple, but it is incredibly important to grasp. There is a vicious tug-of-war happening inside this stock right now. On one side, you have this enormous wave of retail enthusiasm, driven by aggressive revenue targets and a giant recent acquisition. On the other side, you have the grim reality of a highly speculative, cash-burning roll-up strategy, one that is masked by non-cash accounting gains and a continuous, relentless cycle of equity dilution. But here's the twist that makes this so fascinating. It is not a pure disaster story either, because sitting quietly behind all of this is a massive cash war chest, creating a hard floor under the stock price and keeping this entire company afloat. So which force wins? To understand how we got to this conflict, we first have to understand the story that the market thinks it is trading. Right now, the dominant narrative is that Ondas is rapidly transforming into a scaled, autonomous defense powerhouse. And honestly, you can see why the bulls are captivated. They're mesmerized by a handful of very specific numbers. Following a massive $875,800,000 acquisition of DZ9 Technologies and the launch of their brand new Ondas Sentinel division, management came out swinging with incredibly aggressive guidance. They're projecting at least $525 million in revenue for 2026, then add in a recent flurry of $70 million in new orders, headlined by a highly publicized $6,900,000 Australian counter-drone contract. And suddenly the retail crowd is absolutely convinced this stock is on a direct, non-stop path to the moon. But notice the assumption baked into all of this. The mainstream narrative assumes a flawless execution path from here on out. No stumbles, no delays, no dilution, just perfection. But before you get too bullish, there's another layer to this that reveals a bizarre disconnect from reality. Let's talk about how the market actually reacted to that news, because this is where the story starts to get genuinely complicated. Recently, Ondas jumped over 11% in a single trading day, adding roughly $450 million in market capitalization. And what was the primary catalyst for all that? That $6,900,000 Australian defense order. Let that sink in for a second. The market added 65 times the value of the actual contract to the company's valuation. Read that again. 65 times. Yes, they do have $70 million in total recent orders, but that is only a tiny fraction of what they actually need to hit their enormous $525 million guidance. The price action we are witnessing is entirely decoupled from current operational cash flow. It is trading purely, and I mean purely, on terminal value optimism, on a dream of what this company might become years from now. And that brings us to the one metric investors keep pointing to as undeniable proof of success, which turns out to be a complete mirage. If you pull up a basic stock screener, you might spot something that stops you in your tracks. Ondas boasts a massive net income of around $361,700,000. Bulls point to this and say, look, they're profitable. The story is real. But this is an accounting illusion, and here's exactly why. That profit was not generated by selling autonomous defense systems. It was not generated by winning contracts. It was driven almost entirely by a $389,500,000 non-cash warrant gain. Now, what does that actually mean? When a company's stock price fluctuates, the changing value of the warrants it has issued has to be recorded right there on the income statement. But, and this is critical, it does not mean a single dollar of actual cash entered the bank account. It's a paper gain, an accounting entry. So if you strip out those paper profits and look at the real business, you uncover a deep, ongoing operational deficit hiding underneath. Once you wipe away those paper profits, the actual cash burn tells a much, much darker story. The operational reality is far harsher than the glossy headlines suggest. In the first quarter alone, Ondas posted an operating loss of $42,700,000, and that's on just $50,100,000 in revenue. On top of that, they recorded an adjusted EBITDA loss of $10,900,000. This is a company bleeding cash to grow. And yet, because of all the hype, the stock is trading at an eye-watering price-to-sales ratio of over 50 times, and a forward price-to-earnings ratio well over 100 times. Think about what that means. The market is valuing Ondas like a hyper-efficient, high-margin software company that prints money with almost no cost. But that's a fantasy. In reality, they operate in the incredibly capital-intensive hardware and defense aerospace sector, where scaling up doesn't require code, it requires massive amounts of physical capital, factories, materials, and time. So if they're burning through this much cash just to scale, where on earth is all the money coming from? That question leads us straight to the biggest overlooked risk of them all. What the hype machine is blatantly, conveniently ignoring is the true cost of Ondas' aggressive acquisition spree. To fund these enormous deals, the share count has absolutely exploded, creating a continuous cycle of equity dilution that quietly eats away at every shareholder. For the Dilution deal alone, Ondas issued roughly 40 million shares at closing, 40 million. And here's the real kicker, the part almost nobody is talking about. There are another 45 million shares scheduled to be issued in January of 2027. That single upcoming tranche all by itself will dilute existing shareholders by nearly 8%. This is what I call the dilution treadmill. Acquire a startup, issue massive amounts of new shares to fund the deal, dilute the people who already own the stock. Then go hunting for the next target and do it all over again. And the treadmill never stops. And it's not just future dilution you need to worry about. There is a very real ceiling sitting right above the current stock price, right now, on top of everything else. The company recently filed a prospectus to allow the resale of roughly 3,400,000 shares by existing holders, which was tied to their earlier Ondas acquisition. This, my friends, is textbook overhead supply. And here's the frustrating part for anyone buying today. The company itself does not see a single dime of capital from these secondary sales, not 1 cent. But for retail investors buying the stock right now, this matters enormously. Every time the stock tries to make a real run higher, those current shareholders absorb the downward pressure because those early holders use the rally as their exit liquidity. In plain English, whenever the price tries to climb, there's a wall of sellers waiting to cash out on your enthusiasm. This dynamic creates a fascinating split in how completely different types of investors are playing this exact same stock. There is a genuinely remarkable divergence happening here. Retail traders are treating Ondas like a meme stock, like a lottery ticket with a rocket strapped to it. They're cheering for a drone rally and hyping up the mother of all short squeezes across every message board you can find. The energy is electric, emotional, and loud. Meanwhile, the institutional investors are doing something completely different. Quietly, almost silently, they are taking massive long-term positions. BlackRock recently disclosed a 9,300,000 share stake. JPMorgan added nearly 7 million shares. Let that contrast wash over you for a moment. The institutions seem to be buying the long-term defense infrastructure thesis and the safety of that cash floor, while completely ignoring the day-to-day hype that retail is glued to. Two groups, same stock, two entirely different games. And speaking of that retail hype, we absolutely have to address the elephant in the room, the highly anticipated, endlessly hyped short squeeze. Retail traders are frothing over the short interest, and at first glance, I'll admit, the numbers are shocking. There are 229,560,000 shares sold short. That represents a staggering 44.06% of the public float, nearly half. On paper, that looks like the perfect setup for an explosion. But here's why the mother of all short squeezes narrative is very likely flawed. And the reason comes down to one word: liquidity. The days to cover ratio is only 2.7 days. Recently, Ondas has traded somewhere between 100 million and over 280 million shares in a single trading session. When the volume is this incredibly high, short sellers can quietly cover their positions and slip out into that daily liquidity with ease. They can exit without ever triggering a violent, uncontrolled upward price spiral. So yes, the short interest is high, dangerously high even. But the trap door, the thing that actually makes a squeeze explode, just isn't locked. However, as an analyst, you always have to check your own blind spots. Because there is one scenario where this entire math could break wide open. I have to be honest with you here. I question my own certainty on this one. Having 44% of the float sold short is objectively a massive powder keg. It's sitting right there. So here is the tail risk scenario, the wild card. What if Ondas suddenly drops an unexpected bombshell contract? Something so big it halts all the selling pressure at the exact same instant. In that case, the resulting panic buying from short sellers scrambling for the exits could potentially overwhelm even that enormous daily volume. It is a genuine mathematical risk to bet completely against a squeeze, even when the current liquidity says short sellers have a safe and easy exit route, because you simply cannot ignore a powder keg that big. All it needs is one spark. Moving past the squeeze potential, we have to examine the actual promises management keeps making about profitability. Matt Mansham keeps loudly touting that the DZine acquisition will finally make their defense portfolio EBITDA positive. And I have to tell you, I am highly, deeply skeptical of this claim. Here's the problem. Design might have a perfectly profitable profile all on its own in isolation, but you cannot look at it in isolation. You have to blend it into Ondas's existing core operating losses. Remember that $42,700,000 quarterly loss we talked about earlier? That doesn't disappear. Blending one profitable startup into a deep, established operating deficit casts severe doubt on whether we'll ever see a consolidated, company-wide gate profit anytime in the near future. One profitable piece doesn't fix a leaking ship. With all this cash burn and all this dilution, you might now be thinking this stock is simply destined to spiral towards zero. But there is one massive factor keeping the bears firmly in check. This right here is the single data point that stops me from turning overly bearish. I keep coming back to their balance sheet, and honestly, it's baffling. They have over $1 billion in cash and short-term investments and virtually no debt. None. For a company carrying a $4.4 billion market cap, having 25% of that entire valuation sitting in pure, liquid cash is an enormous institutional safety net. So I have to ask myself, am I being too cynical about their execution risk? Because think about this. They literally have enough cash to buy their way out of their mistakes for the next 3 years. 3 full years of runway. Precisely this, is exactly why giants like BlackRock and JPMorgan are so comfortable parking their capital here. They're not betting on a squeeze, they're standing on the cash floor. So when you combine a massive cash floor underneath with an equally massive dilution ceiling above, you get a very specific and very telling trading environment. When you synthesize absolutely all of this together, the real picture finally snaps into focus. Ondas is essentially a venture capital style roll-up company, one that's attempting to stitch together a bunch of disparate cash-burning defense startups into something coherent. It is not a flawless, humming, autonomous machine. Not yet, anyway. And maybe not for a long time. So the realistic expectation here is not a straight shot to the moon, and it's not a collapse down to zero either. Instead, brace yourself for violent, range-bound volatility. The stock is likely to chop savagely back and forth between $6 and $9. That $1 billion cash war chest provides a hard floor right around $6, catching every fall. Meanwhile, the relentless dilution and that wall of overhead supply cap, the upside rallies right near $9. Up, down, up, down. A boxing match with no knockout. And that brings us to the final verdict for anyone actually trying to navigate this thing. The ultimate takeaway, the one thing I want you to remember, is that you have to prioritize signal over noise. Don't just read the headlines. Read the actual filings. Because when you see a stock jump $450 million in value on the back of a $6,900,000 contract, that is exactly the kind of euphoric behavior that usually masks deep, ugly operating losses underneath. This is a roll-up reality. They are stitching together cash-burning startups, and they will require continuous equity dilution just to survive the journey. But, and this is the crucial balance, because of that massive 25% cash-to-market cap liquidity and that heavy institutional accumulation, it has a defined, highly volatile trading range. So here's your game plan. Manage your risk carefully. Ignore the meme stock hype screaming in your ears. And above all, respect the fundamentals. Before we wrap up, a quick and important note. Everything you've heard in this video is for educational and informational purposes only. It is not financial advice, and I am not your financial advisor. Investing carries real risk, and you should always do your own due diligence and consult a licensed professional before making any investment decisions. Now I want to hear from you. If you had to bet right now, is Ondas going to squeeze, crash, or just chop endlessly in that $6 to $9 range? Drop your prediction in the comments below. I read every single one, and I genuinely love to see where you land on this. If this breakdown helped you see through the hype, smash that like button and subscribe for more no-nonsense teardowns just like this one. Until the next one, stay sharp, stay skeptical, and I'll see you in the next video.